Are we making too much of a short squeeze fueled rally in stocks? Of the 57 S&P stocks with the highest short interest, 41% are up 10% or more this month. Our next guest warns the correlation between short interest and equity returns has been running at a high. And after a record Dow close yesterday, he expects that correlation has only gotten more extreme, which may be a warning sign for markets. Joining me now is Tavis McCourt, Raymond James institutional equity strategist. Tavis, it's good to see you. So just kind of run us through the historical record here and how much this episode sticks out to you.
Yeah, so this year is most notable. There's been three significant periods where equity returns have been highly correlated to high levels of short interest, and one of those was late January, which was followed by a pullback in equities for the next 2 months. Another one was May and June on really the AI-related rally. We hung in there for about a month, and then equities kind of started to weaken again. And the third one really has been November and early December. So there's a lot of reasons for the rally, but on top of that, we've had a lot of short covering. And it doesn't mean that we're going to roll over completely, but it does mean some of the fuel for the rally has probably neared its end.
Does it make you more bearish right now?
Cautious, I would say. I think at some point the inflation story is effectively over, but at some point you're gonna need better economic data to keep the rally going at these multiples. When we've had 2 to 3 turns of multiple expansion just in the last 6 weeks, which is really just a substantial amount. You've now got mid caps that had been trading 20 to 30% below historical norms are now only 5% below historical norms. Small caps that were 35, 40% below historical norms are now only about 20% below historical norms. And large caps outside the big 7, which were trading kind of 5 to 10% below historical norms, are now 5 or 10% above. So at some point, you've got to have some better earnings to keep the fire going. So I think we're okay, but the kind of rally from just the realization that the inflation risk is likely behind us, I think that part of this is coming to an end.
Like I say, we're a long way from sticking this landing because a lot of people think we're sticking it right now. I want to just ask you what you said there in passing about valuations. Is that also what's been driving this rally, that valuations are up a couple of points?
Yeah, for sure. I mean, you can think of, at least I think of every equity index is basically pricing in a percentage chance of a soft landing versus a recession. And right now, the percentage chance of soft landing is just skyrocketing in the eyes of the market. But and so that's leading to equity values going up. But if you look historically, most of the times after a rate cycle, we don't get a soft landing. Most of the times after a rate cycle, it takes actually an average of 15 months after the last rate hike to start seeing labor market weakness. Like we're only 5 months after the last rate hike. So it looked like a soft landing in 2006 too. It looked like a soft landing in 1989 too. You just don't know for sure. It's going to be a full year or so before we know for sure if this soft landing really is stuck.